anytime I have a chance to talk to Luke Roman, who is the editor publisher of The Forest from the Trees. I get to see the big view, the macro view with Luke. And Luke also has some, shorter term ideas. Welcome back to TradeGate Hub, Luke. Great to see you, talk to you again.
Thank you. Thank you. Great to be here. Thanks for having me back on, Dale.
All right. I found a tweet. I had to chuckle, but why don't you tell our viewers what the Luke Roman version of zero coupon bonds are in the fourth turning that we're in?
Of zero coupon bonds. Remind me. I'm trying to.
All right.
Yeah,
Gold and
remind me.
Bitcoin. Gold
Oh,
and
yes.
Bitcoin.
Oh, duration. Yes, absolutely. No, I think the 60/40 I think the long-term bond portion and specifically the long-term sovereign bond portion of the 60/40 portfolio is dead. I think it's
Yeah.
trash. And I think that the long-term sovereign bond portion of a 60/40 portfolio should be replaced with gold and a little bit of Bitcoin.
Okay. So the reason you could say that is gold, everyone knows there's no yield on gold, no yield on Bitcoin, but they're a hedge against what we're seeing. I think today the market at today's levels, I'm talking equities, are now closing in on 190% of GDP. Am I in the right ballpark?
That sounds about right. And paradoxically, uh, the way the U.S. has allowed its economy, its policymakers have allowed its economy to evolve. The U.S. needs that 190% equity market cap to GDP number to rise inexorably, um, just to avoid, just to keep the treasury, just to keep the deficit rising only linearly. In other words, if the stock market corrects in any real way and stays down, the deficit will blow out. So for the deficit to go from 6% of GDP to 7 to 8 requires the it requires the U.S. equity market cap to go from 190% to 200% to 210% over time. And that's
Because of tax receipts from capital gains.
well, not just capital gains. They've allowed the stock market to become the economy.
Okay.
And what I mean by that is if you look at IRS data going back 10 years now, net capital gains plus taxable IRA distributions alone are about 200% of personal consumption expenditures growth. Personal consumption expenditures is 2/3 of GDP. So the growth, 200% of the growth of consumer spending is just net capital gains and taxable IRA distributions. Now, that doesn't include stock options, incentive comp, etc., which is all taxed as ordinary income. And it doesn't include the fact that boomers have $76 trillion in assets and they're putting on the biggest YOLO trade, you only live once trade in human history, which is, hey, I can't take it with me.
Yeah.
So, the Fed can raise rates to 5, they don't care. Raise rates to 10, they don't care. Raise rates to 20, they don't care. And the problem is that well before we even get to 10, the U.S. government has so much debt that the U.S. government's finances go boom, and the Fed's going to have to go back to QE. So you're in this again. They they wanted this system, and they're getting it good and hard now. Now they need stocks to go up 10 to 20% a year just to keep the deficit rising linearly instead of non-linearly. So here we are.
Okay. Okay. So, I want to first start with the bond market. I know you're a long-term bear. We talked, and you're, bearish, but we had this rally after two failed bond auctions last week before the NFP. We had a nice rally before the NFP. Who's buying these bonds, Luke? And it's important because you say that bearish action and losses in the bond market is what's creating a squeeze into stocks and gold and Bitcoin. So if the opposite happens for a while, is that going to divert funds from those asset classes? If it works when we're in a bear market to push everything else up, if the bond market continues to the upside, which contrary to you, I think is going to happen here. I don't know why. I'm just a just a technician trading price action, would that hamper the advances that we've had in those other asset
Not
classes?
not necessarily. It depends on what the dollar does. If the dollar goes up, the bond rally is going to end fast.
Okay.
Because that's going to squeeze foreigners, dollar
Well,
borrowings, and they're going to sell treasuries.
that's not happening. And,
It's not
you know,
happening.
that's
Mm-mm.
not, in fact, I think that today was a real critical day um, for this recent rally that we had. It's failing. And, I'm looking for sub 100 in the dollar index, Luke, sometime before the end of the year.
Interesting.
So that, I think the dollar's peaking. We may see some support at the 102 level, but I think we're going to attack par and take it out. So that would
And me
mean
too.
lower yields, lower dollar, and bear market rally in bonds. It's not a bull
Yeah.
market, but a bear market.
No, I think it's the right way to classify. So if let's go with and say, let's say you're right on the dollar and the dollar heads towards 100 by year end, uh, I would expect to see, based on our framework, long-term bonds rally, yields down, like you
Okay.
just said.
Okay.
Stocks to rally more. In other words, I think the dollar going down is going to be really good for stocks. I think it's going to be really good for gold. I think it's going to be really good for Bitcoin. And so I think what you'll see is this. Yes, bonds can rally nominally, and they might be good for a trade on their own. You might make money. The better way to play that, in my view, it has been, and I think will continue to be, in my view, S&P over TLT, for example. So S&P over the long bond. That ratio, which has been rising faster and faster, I think will continue to rise.
Okay.
The NASDAQ over the long bond. Although I don't like the NASDAQ as much as I like industrials, but gold over the long bond, Bitcoin over the long bond. So it's really more of a relative to me on the bond side. There's trades to be had at the long
Yeah.
term. It's not,
Yeah.
as one of my best relationship calls it, it's blood sport. I mean, you can make some money here and there, but I think ultimately the dynamics that you need for a sustained rally in the long bond, number one, they are going to rally other assets more, right? So the dollar goes from 104 to 100. I'd rather own gold, Bitcoin, and stocks than a long bond, although I would fully concede that the long bond will rally, in my view. Uh,
Okay.
the flip side is once the dollar gets to 100 or below 100, at some point, uh, inflation's going to start picking up again. And then that's where it starts to become self-limiting for a trade is now, okay, if inflation's picking back up, what do you want to own? It's like, not bonds. I'd rather own gold. I'd rather own Bitcoin as that liquidity will, in my view, eventually start. We were already seeing a bottoming in inflation, I think, to some degree.
Okay.
A further sequential increase in inflation is the limiter on how far that bond rally can go, in my view.
You see no chance of yields dropping, and say the reason is we start getting weaker numbers in the employment picture, and the economy starts to weaken, and people start to say, you know what, the no landing scenario is off the table. Now it's between a soft and a hard landing. Isn't it possible that we could have risk off, and that could be part of why the bonds rally? I know a lower dollar is jet fuel for everything. When the dollar's bad, normally everything goes up. But isn't there a possibility that yields are going to come down to those levels because of the economy weakening?
They could. The challenge in that, in my view, is that if you get that, that's going to be, like you said, risk off, and that's going to be dollar up. And so the
Okay.
dollar up will be the limiter in that, in my view, because then you're going to get into this dynamic we had in the third quarter last year, which is foreigners have $13 trillion or so in offshore dollar denominated borrowing. You've got the euro dollar liabilities that are of tens of trillions. And ultimately, when the dollar goes up, they sell what they can, not what they want to. And what they have is $55 trillion gross of dollar assets, about $20 trillion net of dollar assets. And within that, foreigners in aggregate own $8 trillion of treasury bonds. And so if the dollar goes up on a U.S. risk off, number one, the stock market can go down. Some of that can go in the bond market. That's sort of the traditional asset shift flows that always made the 60-40 work so well for so long. What didn't exist in that period of time was this net international investment position I just described and these large dollar borrowing. So foreigners, stocks go down, deficit's going to go up on a lag. So U.S. Treasury issuance is going to go up. And that's on a $1.7 trillion deficit now. You'd probably be talking about in a recession, easily $3 to $3.5 trillion in deficits. So that's what Treasury issuance will be from the U.S. Treasury net. Then you're going to have to do the whatever it is roll another 8 or 9 trillion, I think, this year, the next 12 months. Then you're going to have credit losses and some description. Banks will probably be selling. We started to see that with Silicon Valley, et cetera, last year in the first quarter, where they were selling treasuries that they were held at loss positions. But the biggest one is going to be, as the dollar rises, foreigners are going to need to defend their currency and sustain their dollar borrowings, which is going to just mechanically drive $8 trillion of treasury selling. So you're going to have a tidal wave of treasury supply in any sustained slowdown in the U.S. economy. And so I think that's the big surprise coming for people. And that's why I remain a secular bear on bonds is, if we actually get a recession, I think yields probably I think they barely move down at the long end. And I think they actually have a really good chance of going up in a U.S. recession, which I just think won't be allowed. I don't think a recession is a likely case, but in a slowdown, we've seen multiple times over the last 4 years, rising rates into slowdowns. We saw the long end sell off last year with the Silicon Valley thing. We saw it, et cetera. So yes, if you can get a recession with U.S. dollar down,
That's what
maybe.
I was just going to ask you that, because everyone is expecting, and we had some risk off in April, and the dollar didn't rally. Okay. The dollar did not, there was no safe haven buying. And
Mm-mm.
I think that might be some type of precursor to when we do have a recession, that people are moving away from dollar denominated assets, not just bonds, but moving away from anything priced in dollars because other markets overseas have been outperforming the U.S. So is it possible? Let's get into that scenario of the dollar falling with risk off. And that would have everyone wrong-footed because recency bias of the dollar, people go the dollar during risk off, and that may not happen this time, in my opinion.
That is the Fed's worst case scenario. That's where you're going to
Oh,
get into
then
some
for
sort.
sure. Then
Yeah,
for
right.
sure it's going to happen. All right. Let's test them out.
Yeah,
So,
right. Yeah, that's
okay.
their worst case scenario because you get the dollar. The only way you're going to get that obviously is capital flight, right? Like you said.
Right.
Now, with that said, like Treasury and Yellen are pushing as hard as they can to generate capital flight, right? They're
Exactly.
telling China, Russia. I mean, obviously the Russian sanctions we know, but even this week, Yellen came out again and said, "Look, we'll sanction China, we'll sanction India, we'll say." At some point, you hit a tipping point. Nobody knows where that tipping point is ahead of time. And again, foreigners own $55 trillion gross, $20 trillion net. They own $20 trillion more of our assets than we own of theirs. And this is this is not the 1980s. There's a lot of people saying, well, we're going to run the Soros strong dollar, imperial dollar playbook like Reagan did. And these people need to come to 2025 and
Yeah.
wake up because the U.S. net international investment position was positive 10% of GDP. In other words, we had 10% of our GDP net more of our assets overseas to come home than foreigners had here. It was 180-degree opposite situation. And we've
Yeah.
seen this in markets, right? When you see the treasury market sell off in risk off, should be telling people, okay, my Soros framework of the 1980s is wrong, but there's still a lot of people out there trading like it's 1985, and it ain't. It is absolutely not on that front.
Yeah,
So
it's not a flight to quality, it's just another risk asset.
it's just another risk asset. And then you can get into, okay, where's the debt to GDP? Where's the how big was the euro dollar market? people want to say, well, China's just Japan, except, Japan was and still is militarily occupied by the U.S. de facto. China is not. There's a whole lot of things that are different, but that is the Fed's worst nightmare: is the dollar down, stocks down, yields
Rates would go
up,
up. Yeah,
rates would
rates
go up.
because people want to get paid if the debt is in a failing currency. There's going to be higher rates demanded for anyone who buys debt.
And I think when you see, and I don't think the currency will fail, of course, but I think from a standpoint of the geopolitics, I think there's a lot of rates traders out there that are just like pretending the geopolitics aren't what they are. The
Yeah,
fact is in the Cold War, U.S. net debt service above was never above military spending, ever, from 46 to 89, ever. It already is. And we're
that's
in
a
like
long time ever.
yeah,
Long time.
we're
Yeah.
we're in the warm up. Here in Cold War 2.0, we're like in the warm up, right? Right. We're out there warming up. We're in the early innings, and we're from a starting point. Our net debt service is above our DoD spending. So I think like rates traders are in la la land. Like the to me, the only dots that matter are do you think Powell is going to defund the US military by raising rates to fight inflation? Yes or no? And if your answer is yes, then great, buy bonds, secularly, but this but to me, the answer is no. I think there's zero chance of that. The United States isn't going to lose a Cold War because rates, because we have to pay the interest. We let the market set interest rates for it. So to me, I don't know if that's this meeting, if it's next meeting, if it's whatever, but that's coming. we
Okay.
in terms of the rates traders looking at this ex geopolitics. Well, looking at rates right now, ex geopolitics is like asking, Mary Todd Lincoln, like, other than that, how was the play, Mrs. Lincoln? Like
Yeah. Yeah. Okay. All right. So I think we've covered that ground. That's going to be an interesting scenario. The Fed's worst nightmare is risk off and a declining dollar at the same time, which would drive rates higher. The Fed is meeting today, and you said you don't know if it's this meeting or the next meeting. Do you really believe that the Fed leads the market or the market leads the Fed? And will we know during the presser after this reaction and yields dropping pretty good? I mean, this is the biggest one-day drop in the 10-year I've seen in a long time, and I think they're going to challenge these lows down here at 380 over the maybe into the fall. Um, is he going to talk like a dove? Because the market's already acting dovish. It has for about 2 weeks now. Does the Fed really lead the market, or do bond traders lead the market? And then he kind of tap dances into the direction of the market.
I think there's times when one is true and times when the other is true. I think it's a little bit of both. And I think there's an element where I just keep watching, like, at key moments in rates, key moments in the dollar, key moments in markets over the last 2 years. We get these do ex machina miracle data releases, right? Like, just when we need a soft data report, we get a soft
Yeah,
data report. Or just when streets getting a little carried away with 6 rate cuts, we
yeah.
get some hot data. Like, if
Very
you
well
read the
managed news.
it's very well managed news, and that's where I get, to me, and people say, oh, some people might say, oh, that's crazy, but to say that's crazy is to be ignorant of history. Like, pick up a history book. If you don't think the politicians in the middle of a Cold War aren't managing the data, you're naive. So, who knows? Let's see. But I think there are times when the Fed leads the data. I think there's times when they are catching up to the data. I think there's merit in both. I think it depends at sort of where you are in sort of these trading ranges. And I think it's helpful for investors and for traders to take a step back and really to see, okay, where the big picture of we know they've got this much debt. we know they can't afford the 10-year much over 5, maybe much over 4.8. We know we need to spend a whole bunch of money. We know, so like how can they, and if you
Keep
kind of
all
know
those
what,
balls in the air.
yeah, and if you start from I find myself increasingly doing this, start from sort of like the end goal of the combination of monetary and fiscal slash geopolitical policy and work backward in terms of what do they need to today, and then sort of put those positions on, like it's been working. So I don't know, I see both arguments. Um, I see
Anyway,
both arguments. Yeah, I mean, and
I
and that's it. Yeah, it
yeah
varies, right?
yeah
Like
they're bipolar. He's bipolar. He needs lithium, in my view. And anyway, I could say that because what do I have to lose? I want to talk about the gold. Okay. And this is one of your zero coupon bonds. And we had a big down day here when there was news circulating that China didn't buy gold that month. First of all, do you believe the story that they stopped and maybe only for a month? Or is it through my experience of watching how the Chinese trade in grain markets and any other market, they'd come out and say they're looking to sell something so they could buy it cheaper, and they were looking to buy something so they could sell it at higher levels. Do you think that's what's going on? Because it did create lower levels for them and may
it create,
continue.
yeah, it create. I don't know what, month to month. Obviously, it created lower levels. Oh, it didn't hurt that it came out on a Friday, so the Chinese were already at home. So if you
Yeah,
watch how that gold traded, it was like they
yeah,
came in, and oh, by the way, they were on holiday. The Chinese were on holiday on Monday, so whoever was leaning on it all day Friday didn't have to worry about the Chinese showing up, on
yeah.
Sunday night and squeezing them on the other side. So like
Okay,
it was interesting to me in that we haven't seen one of these kind of moves for, sort of these down 3% in gold for a while. Uh,
yeah,
with that being said, the way it's rebounded as your chart's showing,
yeah,
it further reinforces, in my view, the Chinese are in control of the gold market through physical now. The U.S. could push gold around all it wanted to as long as oil and other commodities were only priced in dollars. Because a rising price of gold in China, when oil's only priced in dollars, means that the Chinese yuan's falling against the dollar, and now oil's getting more expensive in China, and they're moving towards running down dollar reserves, and they're in trouble. When you can buy oil in yuan and gold in yuan, that changes everything because now a rising price of gold in yuan means gold buys more oil in China in yuan than it does in the dollar. And that sets
okay,
up this beautiful arb of sell oil in the West, take the dollars, buy the gold, take the gold, send it to China, deliver the gold, get the more barrels of oil per ounce of gold there, sell back to cover your short, free oil, wash, rinse, repeat until either the gold to oil ratio in the West matches the gold to oil ratio in China, or London
okay,
and New York run out of gold, and we get a gold situation with like we had with nickel a couple years ago, which is force
yeah.
majeure, price goes up 3x, blah 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 blah. So I still don't think most market participants really grasp and appreciate the importance of the yuan oil contract from that perspective. And then what that means for gold, and more importantly,
What
what that
dollar?
means for rates, right? Over
Yeah.
time, US inflation expectations track gold. So if the Chinese control gold, they can influence US inflation expectations. If they can influence US inflation expectations track with US long rates. Inflation expectation, they can influence inflation expectations. They can influence U.S. long rates, and if they can influence U.S. long rates, and
That's a
you're,
lot of leverage.
you better be very careful about what you cut off and what you sanction them on,
All right, you talk,
because
yeah,
yeah,
because they have a weapon.
they can blow up the treasury market. People say, well, the Fed will just buy it. Great. Now gold's going to go up more. Now what are you going to do? Because the Russians and others will sell oil in yuan. Now what are you going to do? Well, And we're heading that way one way or another, right? This sort of the Fed's going to have to buy a lot more of the Treasury market, but that would that yeah, it's a potential measure of financial warfare, and that is the importance of yuan oil, yuan commodities, etc. And it's that's still very underappreciated in my view.
Okay, and you talk about the gold oil ratio turning. I saw it in your stream, which means gold's outperforming oil. And I know how important you believe oil is, that it's really the economy and dollar value and everything is really about oil. So for gold to be outperforming what you consider to be a very important, critical commodity, that's the economy. What does that say about gold outperforming a very unique commodity that the world needs to run on?
Yeah, for us, energy. This is a quote from our friend Jeff Booth that energy's the base layer of money, right? And debt is
Right.
just a promise to do work in the future. How do you do work in the future? You expend energy. So energy is the base of debt. It's a base of money. Oil is the most important of those still, despite all the attempts to sort of reduce its importance over time. Uh, Gold over oil. Gold is just a neutral reserve asset. So the to me, the gold to oil ratio is essentially a pressure gauge or a pressure gauge.
Thermometer?
It's basically a thermometer measuring um, the existing dollar centric system around the petrodollar system, if you will, right? So if the petrodollar system needs low gold to oil ratio, why? Well, you need relatively high oil prices in the denominator because relatively high oil prices do two things. Number one, they create dollar surpluses amongst OPEC to be recycled into treasuries and U.S. financial assets. And number two, relatively high dollar oil prices constrict emerging market growth because they have to have dollars to buy oil. And so basically, it keeps oil too expensive for emerging markets to grow too fast and frees up more oil for the Americans. And that's the relatively high oil denominator, a relatively low gold price because gold competes with treasuries as a neutral reserve asset. So if you've got a low gold to oil ratio, you've got a very healthy petrodollar system where oil surpluses are flowing into dollar assets. Oil prices are high enough where they're constraining emerging market growth. And gold's not competing with treasuries because everybody trusts treasury bonds. If you flip that around, a relatively high and rising gold to oil ratio is gold increasingly competing with treasury bonds as a reserve asset because it's not trusted for one reason or another as much. And or low oil prices, which again, low oil prices are problematic. Number one, it increases growth in the emerging markets, taking capital from the U.S., taking oil from the U.S. Consumer, and it also mandates treasury selling, U.S. dollar asset selling by OPEC plus. If they're underwater, if they're selling oil at below break even fiscal break even prices, they need to sell treasuries to finance their own domestic policies. And so you are unwinding the treasury market there too. So
Okay.
low gold to oil ratio is a sign of a negative or a sign of a healthy petrodollar, and a high gold to oil ratio is a sign of a straining petrodollar market. And gold to oil ratio has gone from 8 barrels per ounce of gold in 2008 when Putin started buying gold for reserves in large amounts. Last week it hit 32 barrels per ounce. So in the price
Wow.
of real money and the price of oil, gold's up 4x since 2008, which is a nice little, it's a nice little a
Yeah.
return, So that's the importance to me of the gold to oil ratio.
Okay. I want to wrap it with this. So everyone knows that based on what you have been saying for a while, Luke, this is all going to come to a head. Who knows? A year from now, a couple years from now, we'll see how they manage it. And you say that they're, trying to give hope to people. The only way out, am I reading this correctly, is rates at minus 12% to minus 18%. So we're talking about negative rates. And when I first met you, that's one of the things we used to talk about, that people didn't realize how negative rates can get and how where they've been before. That it wouldn't be that unusual for us to have negative rates. Or the only other solution would be a productivity miracle. And all I could think of is, can AI be it in some way where it's talking about replacing labor in a big way? So is that correct? The only way out is 3 to 5 years with negative rates between 12 and 18% for 3 to 5 years, which I can't imagine what the dollar would be look like and where gold prices would be, or a productivity miracle. And do you think AI might be that miracle or a disappointment?
So on the rate side, it's critically that's real rates, right? So negative 12 to
Yeah,
negative 18% real rates over a span of 3 to 5 years, which
right.
that would imply, yeah, significant rates of inflation with basically the Fed and or other policymakers involved in some version of yield curve control to prevent the free market from taking basically capping bond rates it's essentially a restructuring of the U.S. and global system over the backs of Treasury holders. That's option one, and that critically that can be done longer term. You could do 10
like
years of
like
negative.
Japan did, like Japan did,
You
yield curve
could, but
control.
yeah, but the difference is that we are internal or externally funded. Japan's
Right,
internally funded. Their
right,
positive net international investment position were negative. So
yeah,
we wouldn't get the leeway that Japan has at all, not
okay,
even close. So we could try to do yield curve control of negative 6 to 8% real rates for 10 years, but again, that's going to be harder. Or you could do what the Israelis did in the 80s, which is 2 years of 200% inflation, and it's over. And bondholders lose sort of, most of their money on a real basis. And the government's debt to GDP drops precipitously in a very short period of time. And away we go. That's another way you could do it, right? So it could be much shorter. It probably wouldn't even need to be 2 years. You'd 1 year, 200% inflation, boom, you're done. The inflation surprise. So it's not my base case. There's other ways to do it. But barring a productivity miracle, the debt is what it is. You need a sustained period of very negative real rates. So that's one. In terms of, can AI be that productivity miracle? Maybe. If it arrives at just the correct pace and creates just the Goldilocks amount of unemployment relative to corporate profit growth, and our leaders are wise and implement tax and fiscal policy that matches that, then yes, it can be.
so a 0% chance.
That's what I'm assigning it. Because the problem is what if I came out and said to you, in the next 2 years, unemployment's going to 10%. What's the U.S. deficit going to be? It's going to blow out. You're going to have a depression. They're going to, right? Well, whether that's because of the economic cycle or because AI and humanoid robotics have replaced 10% of the workforce, it's 6 of one and a half dozen of the other in terms of the fiscal impact. Tax receipts are going to plummet. So political instability is going to skyrocket. Welfare, et cetera, entitlement payments are going to rise. Counter-cyclical payments. So it would blow the deficit out. And, look, you take unemployment to 10%, what's going to happen to consumer loans? They're going to blow up across the country. And what if you blow up consumer loans, what are banks going to do? They're going to blow up across the country. And if the banks blow up, they're sitting on 4.2 trillion in treasuries and duration to sell to cover their losses. The treasury market will blow up. And if the treasury market blows up with the government debt where it is, the government blows up. So paradoxically, if AI arrives too fast and creates unemployment, it's
Interesting.
not really any different than than the 2008 great financial crisis when unemployment started going up. It blows up everything really fast. And so to me, AI is paradoxically inflationary because I think it's just going to force a moment where if AI does what some people think it will do, it'll be great for corporate profits. It'll be great for stocks, right? I mean, in theory, you can fire half your workforce, and the execs can take all the money and pay out bonuses and to shareholders, which is great, but that doesn't help the bottom 99% of this country. And when you have 99% suffering while 1% does well, A, it's a political issue, but B, more importantly for the economic side of it,
They
those
can't buy
99%,
anything.
they can't buy anything. They
Whatever
can't,
you're making, whatever you're doing with AI, they can't buy anything.
they're defaulting on their loans. Yeah.
Yeah,
So exactly. So that's the paradox of it that I'm not seeing a lot of people. I mean, there's a few. Like I said, my friend Jeff Booth is all over it. Preston
yeah,
Pish is all over it. Bitcoiners are all over it. They see what AI means, which is AI, if it does what they say it's going to do, and humanoid robotics means the Fed is going to have to fully reserve the bond market. Fully reserve the bond market means the Fed's going to have to buy it all with printed money, which is inflationary, not deflationary. So let's see how it plays out. Again, if there's a uber Goldilocks scenario, AI and humanoid robotics could work out fine. But the challenge is it's just arriving so fast. It's not that, will AI and humanoid robotics be great for humanity in 50 years? Oh my God, it's going to be unbelievable. In 20 years, unbelievable. But between here and there, you're
yeah.
talking about a rate of change of disruption to the labor markets, consumer debt markets, et cetera. It's simply too disruptive. You're moving too fast. You're going to break a whole lot of things.
It's like trading and investing. The art of it is not the if, it's the when.
Yes, that's right.
All right, Luke Groman, the forest for the trees. I think that we've all seen the forest, and I think there's some embers out there flying around like the California fires. So be safe and consider what Luke is saying so that you can preserve wealth in what might be a major crisis for our country and the world coming up. And just one comment. Will whoever is elected have any impact on your narrative?
It depends on what they do, but as it stands now, I'm looking at industrial policy financed by fiscal deficits and possibly the Fed in Biden against industrial policy financed by fiscal deficits, possibly financed by the Fed in Trump. Potentially different areas of the economy, but
Yeah.
that's as it stands today. I don't see much risk to what I'm talking about from regardless of who gets elected.
Okay. So different parties, same puppet masters.
Two wings of the same bird.
Luke Roman, always great and enlightening and edifying to have a conversation with you. Appreciate it. People consider Luke a subscription. He quotes, before you proceed, step back and look at the big picture, lest you act rashly on raw impulse. That's called FOMO, Luke. So uh, you won't, I guarantee you, I read Luke's stuff, you won't get FOMO. So stay calm and read The Forest for the Trees by Luke Roman. Thank you, my trading warrior brother. Appreciate
No,
it.
thanks, sir. Thanks for having me on. It's always great talking with you, my friend. Be
All right.
well.
Luke Roman, everybody. Hope you enjoyed. It's recorded. You'll be able to watch it again. Don't just count your bonds and your coins and your grains. Count your blessings. See you in the room. Adios. Thanks, Luke.